Welcome, ladies and gentlemen, to our regular 6-minute strategy. Better than expected inflation data from Europe, the US and the UK over the last 2 weeks has reinforced the message that global interest rates have likely peaked. This has triggered rallies in equities, bonds and infrastructure funds, where discounts are at last starting to narrow. For balance mandates, these simultaneous moves across asset classes are particularly welcome. European equities, though, are still laggards, much as they have been over the last 5 and 10 years. The MSCI European Index has delivered a return of just 4.4% per annum for the last decade, against a return from the World Index of 8.9% and nearly 12% for US equities, according to Bloomberg. Today, not a single European company makes the global top 10 in terms of market capitalisation, while Europe just boasts one technology leader, namely ASML, the Dutch semiconductor equipment manufacturer, which we've held for many years. So I've set out on a journey to try and understand whether this protracted European underperformance is justified. My first stop this week was to go to the source of the river, namely to Brussels, to see the European Parliament. There I met members of the Commission, MEPs and even NATO members, and I talked to them about what it would take to see a renaissance in European growth. So let's begin with our regular chart of market performance for the year to date. In the left-hand panel you can see that dark blue line, global equities, up strongly over the last 2 weeks. The light blue line, world equities, equally weighted, which ignores the impact of the super cap technology stocks, still positive but a huge gap with the blue line. And that dark red line, the gilt index, almost break even for the year to date, a big turnaround. What's caused this? Well, of course, better than expected inflation numbers across the developed world. In light blue, UK down from 6.7% to 4.6% in October, 3.2% for the United States and just 2.9% for Europe. All levels which should encourage us to think we have now seen the peak of central bank rates. So what does all this mean from Europe, and what did I learn on my visit to Brussels? Well, Mario Draghi was speaking and he said the European economy has been losing competitiveness for the last 20 years. And you can certainly see this over the last 5 years in the euro area GDP I've shown in the left-hand panel. The sharp contraction during COVID, the big rally, and then that fade down to somewhere close to zero. And certainly Draghi was talking about a potential recession at the end of this year or early next. Most of the MEPs and others that I talked to cited 3 geopolitical challenges particularly affecting Europe. China trade disputes, particularly electric vehicles, the backwash from the Ukrainian war, and competing with these huge US green subsidies. In addition, energy costs are still higher than their neighbours and energy security is poor. The technology gap with the US is widening, and simultaneous monetary and fiscal tightening with high public debt levels means another European financial accident is always around the corner. In summary, really, in terms of what the Commission was doing, I heard the same theme. Big growth themes tend to get lost in legislative reality. More productivity needed from the European Commission. So let's look at some of these points in a little more detail. Well, first, the good news, that inflation number really is improving, and despite the gas issues with Russia, the energy component of the CPI now almost completely rolled out year on year, those yellow bars you can see there. Great reduction in the impact of food, alcohol and tobacco. And really what we're left with is just core service sector inflation, which will be harder to squeeze, but the numbers are much better than I think we dared hope for even a few months ago. On the right-hand side, here's the problem though. Europe has always regarded itself as a centre for manufacturing, and here industrial production is particularly weak. If we set the index at 100 for the eve of COVID at the end of 2019, you can see that most major regions are down, the German giant sharply down, with industrial production dropping by almost 10%. And this was a perennial message I heard as I travelled around the Commission and the Parliament. What's behind that? Well, you can see on the next slide the impact on research and development patent applications. R&D as a percentage of GDP, which gives you some idea of the innovativeness of an economy, really weak there in the UK and Eurozone. A big difference from the US back at 2.6% to the Euro 27 at 1.4% of GDP. In a similar vein, Europe appears to be lagging sharply now on patent applications per capita. Yes, Germany still dominates the US, but by a much smaller margin. But look how weak French and UK applications for patents have been. Again, a sign of competitiveness and innovation. Look back in the 1980s, by the way, and you see that UK used to dominate those patent applications just 30 or 40 years ago. Thirdly, the big worry was high government debt that makes countries vulnerable as rates rise. Certainly the big debtors, Italy, Portugal, Spain, France and Belgium, really stand out, those blue bars of general government debt to GDP. What's more worrying is the red bars, which is where they were just 15 years ago. And you can see the huge increase in debt the great financial crisis, the European crisis and the pandemic had on national balance sheets. The difference with the smaller companies in Germany is very marked. You can see Germany, Slovakia, Malta, etc., all running debt to GDP levels below 60%. So there's huge tension, and certainly governments are trying to resolve this, resolve a new fiscal compact by the end of the year. And they need to move fast because we have a worry on the horizon. In fact, it's coming just the end of this week. Italian debt is at risk of being downgraded to junk by Moody's. Remember back in 2010, this happened to Greece and was a trigger for a lot of the European debt crisis that then followed. So what does all this mean in summary? Well, certainly Europe's not going to catch up with US technology numbers overnight. That means on the left-hand panel, you're going to see other years where NASDAQ in yellow dominates the returns from all other indices. But if in fact those US tech stocks begin to roll over and cheaper European industrial stocks gain momentum, then there is opportunity. Yes, energy costs are still high. Yes, government debt needs need to be stabilised. And yes, we have a competitive problem with China. But as you look at your thematic portfolios today, remember the leadership we can still get in Europe from engineering, from power, from luxury autos, from pharmaceuticals, and from luxury goods in general. So yes, Europe is a component in our thematic portfolios. It's not a significant overweight. And really for the reasons of long-term competitiveness, we still would like to see a lot more reform, a lot of changes out of the Commission, and a refocus on competitiveness, and particularly the relationship with China. I hope that's helpful. Thank you.